All right, we are live officially for the Mike and Mario show, and it's been a minute. It's been about a week or so, but here we are now, and excited to be back. And over the last week or so, lots of things are unfolded. Just more revelation as to where we're really, where the global economy is really heading. And of course, debt markets imploding. You know, we got a lot of inner turmoil in our country, in the UK, you name it. But we're gonna dive into a little bit of that and just pretty much wrap up the entire all the sequence of events throughout this week. So before we do that, Mario, how you doing, my friend? Welcome back.
Oh, thank you. I'm fine. Yeah, last Friday I couldn't make it. I had to go to the eye doctor to check the operation. I went again today,
Yeah,
this morning, but it's healing. It takes a little while, but no,
yeah,
everything is fine. I noticed there's a lot going on, not just on your side of the pond, but here too.
mhm,
Um, we had the Fed decision. They left rates unchanged. Bank of England the next day they left rates unchanged, even though
mhm.
our CPI is almost at 7% and our rate is only at 5.25. They think
Yeah,
that's enough to bring inflation down. But as you said, there's so much going on. So I'll let you start now with what you're seeing in the U.S.
yeah. Good deal, good deal. So for those who are plugged in, feel free to share whatever you're seeing out there as well. When we get to the Q&A portion, we definitely want to get you guys involved with Q&A and stuff like that. So have that stuff ready. And also, I see some new names and some new faces, some new visitors to the program. So definitely hit the subscribe button and bell notification and thumbs up. Show your support for the channel. So yeah, so over here, man, like as I've always said, wherever Motor City goes, that's for the most part where the rest of the world will go. And so let me just thumb through. I'm gonna just keep it in order. I'm not gonna go out of order. I'm gonna show you what I've been keeping an eye on the most. Let me pull this up here. So real quick, in no particular order, or just from yeah. So no particular order, but just a lot of articles that caught my attention this week that really just highlights how uh, pressing the times are these days. So here we have world debt surges to record 307 trillion. And that's a very large number. But then again, we have the derivatives market, which is 1.2 some quadrillion. So debt, of course, is the primary issue that the world's facing right now. And then here domestically, the U.S. national debt hits 33 trillion for the first time. So just to see that debt clock continue to spiral up is not too exciting, just because there's no way of resolving these issues. Then we got a government shutdown that's looming. And so this article here said government shutdown risk spikes as House Republicans leave town in disarray amid hard right revolt. So this right here is not doesn't come at a good time, given the fact that
Well,
go ahead. I'm
I,
sorry. Go
I
ahead. You
would
got some.
I would say that's a good thing, as long as for if the government remains shut down forever. I mean, that would be great.
Yeah, that would be good. Yeah, but I don't think the controlling forces behind all this monetary rigging really needs this additional pressure right now, because this ultimately will impact the anticipated debt issuance in the next year or so. It's like if we can't get our stuff in order, we never could. But who's really going to be on the buying end of all those liabilities? So yeah, but more
Yeah,
and more problems.
yeah.
And then of course we go ahead.
Sorry, that 307 trillion,
Yeah.
that is a problem. But the other problem is that our system is based on debt. So the
Hmm.
economy, if we reverse all the debt, the whole thing implodes. We go into a Great Depression. And
Right.
it's interesting that 10 trillion was created in the first half.
Hmm.
And I think the US total is around 100. So the US has about a third of all the world's debt.
Yeah, and so it's a doom if you don't, and doomed if you do. It don't matter anyway it go. It's not looking pretty. And then what else we got here? Let me just go. Okay, so student loan payments are about to resume, and I was just reading through this article here, and just people have gotten very comfortable over the last 3 years of not having to pay anything, and they have mismanaged whatever funds they did have by taking on more, I guess, luxuries and responsibilities than they can afford. So it's going to be a lot of tough decisions coming up, and it's saying defaults are expected to follow. So that's
Yeah,
going to be
I,
something that will hit hard. Go ahead.
I think people are already discounting for that in their spending habits, and I
Hmm.
think this could be what trips the economy into a recession. Actually, this
Mhm.
student loan payments, because the American savers, they're running out of all their, say, the all the cash injections they got
Mhm.
during
Mhm.
COVID.
Yeah.
So you should expect to see credit card borrowing continue to rise. I mean, it's over $1 trillion already.
Mhm.
It's gonna it's gonna be a mess, I think, and this is one of the major, it's like the domino that's gonna trigger a lot of things, in my opinion. And we
Right.
saw as well that mortgage rates are going up.
Mhm.
The 30 year is almost at 8%.
Mhm. Mhm.
So things are not getting easier. And you said earlier that, where I think it was the CEO of General Motors many years ago, he said,
Mhm.
as General Motors goes, so does the US. But that's
Mhm.
changed now, actually. Because US is not a manufacturing powerhouse anymore. Nowadays,
Right.
it's where the Wall Street goes, so goes the US,
Right.
because we're dependent on on the credit cycle, right?
Correct, correct. And so, like with with the motor, especially the Motor City, like majority of the vehicles that come off the line are beyond affordable. And so, if people don't have ability to finance those vehicles, there is no car market. And that goes to the idea of just being a consumer nation. So that's definitely going to be an issue. Then also, you mentioned about you know savings and things of that nature. And I'm of the mindset that all the stimulus funds, which for the average Joe was only a couple hundred or a couple thousand. I believe that stuff was long gone. And that has led to the surge in the usage of credit cards, to the point where people have literally been living off a swipe, not necessarily anything to do with savings, because I don't think your average person really has made much savings. So,
Yeah.
um, then again,
Maybe
we're going to
we
find out.
could, maybe we could talk a little bit about the strikes, because we have strikes here as well in the NHS and a lot of other sectors
Mhm.
of the public sector. Our public sector here is really big,
Yeah.
unfortunately. But and you also have one in Detroit, the car makers, car workers.
Yeah.
And
Yeah.
one thing I noticed in the press, especially from the right wing press, is that they have a go at the workers for wanting a pay rise. And
Mhm.
then yeah, and even the central bankers here, the Bank of England, they seem to equate people asking for wage rises as being inflationary. And I think that's totally upside down. And
Mhm.
I just wish the people in the unions would learn a little more about how money works, and the fact that it's government and the central bank that debase their earnings, and they wouldn't be striking. They'd be working and earning and doing okay. They wouldn't strike. Why do they want to strike? Well, because the currency is becoming worth less and less, and they're buying less things. I
Right.
I don't know if you've heard Henry Ford in the beginning when he started out. I think it was the Model T. He
Mhm.
actually increased uh,
Waiting.
his workers by $5, which at the time was huge.
Right.
And people thought he was crazy, but what that did is a lot of those people, they went back and started buying Model Ts
Right.
themselves. So, and at the time, $5 was something real, of course.
Yeah.
Nowadays,
Here, so just speaking of, like, that is, yeah, that is something else. So I actually wanted to pull it up here, and that's $5 a day. So let me. It says the story of Henry Ford's $5 a day wages is not what you think, according to this person here. But given the overall economic conditions they had then, it was a big deal because it allowed Ford to become the biggest auto manufacturing plant in the world. So very interesting. But speaking of strikes, and so here, like in the Motor City, I just saw an article a moment ago saying that uh, they are now about to ramp it up. So it's happening in phases. So phase one started last week, where just a small amount, I think it was 1,000 or 2,000 or so, decided to walk off from the job. And so the ultimate desire is more pay, a pension, an old school pension, solely vested, solely responsible by the company, and to get rid of the tier pay system and less work hours. So more pay, bigger pension, work less. And so, as of right now, those demands, of course, according to what they make, can't be calculated in there. But then again, that disrupts the whole business model of being in business for
Yeah.
profit
Yeah.
and to return value to the shareholder. So somebody commented on one of my posts saying, Mike, these people work hard, and you're siding with the corporations. But I'm thinking like, it's the corporations that give them opportunity to work. It was
Yeah.
never designed to be their sole
But
source of everything because they have to run a business.
I'm going to counter you, Mike,
Give it to me.
because I've been reading this book here, the Price of Time by
Yeah.
Edward Chancellor, and he
Okay.
talks exactly about shareholder value,
Hmm.
and up until from Glass-Steagall in 1933 up until
Hmm.
1982,
Hmm.
corporations could not buy their own stock. It was illegal
Hmm.
because they
Hmm.
could manipulate it, right?
Right.
And if you look at the and I'm not like having a go at CEOs or people who run businesses, but
Hmm.
you need to find a balance. But in the 60s and up until like late 70s, the average CEO used to earn about 20 times the average worker. Do you know
Right.
where it is now? 399 times.
Yeah.
And the reason they've been able to do that is that they made in 1982 they changed the law and they allowed corporations to start buying their stock. You've seen interest rates go down massively for 40 years. We're down at zero until recently. So
Yeah.
what corporations have been doing, they haven't been trying to in the past, prior to shareholder value, companies they try to build a good product. They try to please their customers. They try to pay their workers properly and make a profit. That was
Mhm.
what they looked for. But
Right.
now, what they try to do is just enrich the CEOs and the
Mhm.
shareholders, and to 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 hell with everyone else and the workers. If you don't accept this pay, then we're going to close the plant and we're going to move to China or somewhere else. And that's what they've been doing,
Yeah.
unfortunately. And to top it all off, now all that inflation that has been pumped in the system with the low interest rates, it's turning into it's going into the basic necessities. So a lot of these workers, they're saying, we're working this much and we can't make ends meet, and we
Mhm.
got the CEOs earning almost 400 times what we earn.
Mhm.
I can kind of understand it, but
Yeah.
it all
Yeah.
goes back to the sound money part, because if we didn't have a central bank manipulating interest rates lower, then corporations wouldn't be able to borrow, because a lot of the buybacks, they don't even take the
Bro.
profits. They just borrow it cheaply. But that's
Right.
like actually that's gone down
Mhm.
recently because rates are higher. So it's very it's not as clear cut, I would say.
Yeah. And speaking of which, while you were talking, I pulled up just a little visual aid to highlight the how wide that margin is. So let me pull this up here. And so this says the five companies with the largest CEO to worker pay gaps. And so CVS is 434 to 1. Then we have a CBS 395 to 1, Disney 367 to 1, TJX
Yeah.
327, 21st Century 311 to 1. So
Well,
um
there's another article I found, and they look at the ratio, what the CEO, and they have a chart going back to the 60s, and back then it was 20 times. I
mhm.
mean, so if a CEO earned $1 million, the worker would earn, like 50,000. you know,
Yeah.
it would be more fair. Yeah, that's the one. If you scroll down, you're gonna see the chart. Keep going. That's the one I found. Yeah. There you go. Look at,
Oof.
and it started picking up there when they in the early 80s, when they made it legal for companies to buy their stock.
Yeah.
And it's been 4 decades of just it's financialization, it's
Mm.
financial engineering,
Yeah.
and all it's done is hollowed out. You got the term the Rust Belt in the
Yeah.
U.S.
Yeah.
This is what it did to the Rust Belt, and yeah, it's surprising that they're still making cars in Detroit, I would say.
Yeah, but that's the thing. Like the cars they are making, The average Joe, no, I mean, your average Joe can't afford it. So literally, that's where you get into the idea of credit, to where
Finance,
people have
yeah,
to be able to, you know what I'm saying? So here in the developed world, it's good to say we live good. We live high on the hill for the most part, figuratively speaking, because we can finance everything. And as of right now, we're witnessing with borrowing costs and issues and debt issues we're having, it's unsustainable. So something's going to give. And I think we're now in that period to where we're witnessing the unraveling of this debt
yeah,
Ponzi scheme. So it's to be expected. But let me see. Let me show you something else. So as of now, as of today, they just I just saw a little update that UAW they're about to up it. It says UAW's FAN announces expanded strike targets 38 GM and Stellantis distribution plants. So they're holding to their guns, and then
yeah.
they're going to more people are going to walk off. On top of, I think Ford and GM they had some temporary layoffs. So literally, they're trying to shut down operations completely, and it's not going to fare well because I think 3% of our GDP happens to be in the auto manufacturing, car manufacturing business, and they said at this current rate, 250 million may be lost daily, but then within a certain period, 7-8 billion. And so if that stuff really happens, then just less tax revenue for the government that would further expand the deficits.
And interesting because back in this book that I told you about, they talk
Mhm,
about how a lot of these big industrial companies they became basically like General Motors or GE. They became a hybrid. They became like
mhm,
financing
mhm.
and manufacturing companies. And yeah, General Motors had to be bailed out after
Mhm.
the '08 crisis. It, it,
Yeah.
it probably shouldn't even be around if you think of it, in the free market sense.
Right.
Maybe those
Right.
people would have found a job doing something that pays better. I don't know, but it's all. I mean, 3% is not that much, is it?
Right.
It's gone down a lot.
Yeah. But also think about if they would have let all the malinvestment, all the issues just unwind, right now we'd be in a totally different boat. We'd have been probably through some of the rebuilding phase. But then again, it was never about letting the markets correct themselves. It's all about continuing the agenda of expanding the debt bubble. Like literally, they could there. And so the question is, how much more are they able to get out of this debt bubble? You know what I'm saying?
Yeah,
Because as of
yeah,
now, they can maneuver, and it's
yeah,
profitable for them.
yeah.
Go
I
ahead.
mean, that bubble. There's, as we saw, they're still being able to pump
Hmm.
it. There's still 10 trillion in new debt in the first
Hmm.
6 months of this year in the world. Even though the Fed's raising rates, a lot of the stuff that the Fed did, all the QE in 2020, 2021, that went into the reverse repo.
Hmm.
And that's winding down. What that means, all that money that was out of the system now is going into the system,
Hmm.
and that will actually be inflationary. And that's why I think the Fed's still worried about interest rates. You showed that Fed governor saying that rates have to remain higher for longer.
Hmm.
And you asked me before we started if we could see double-digit rates.
Hmm.
I definitely think we can, and it will be not right away, but eventually, I think we will
Hmm.
because it's the only. Well, if they want to save the dollar, that is. I mean, here in the UK, the Bank of England they stopped raising rates this week, and I think they're opting for a weaker currency
Hmm.
because we can't afford higher rates, or else we're going to destroy the credit-driven economy here. And I think it's the same thing for you guys.
Yeah. Yeah. And speaking of what you mentioned, the reverse repo. So I'll pull that up. Let me move myself out the way here. So here we have overnight reverse repo purchase agreements. And so as it's, this in the beginning of all the bills and stimulus, they were just, it was funneling, all the banks funding these funds are here. And now
Yeah,
it's coming down now. But
yeah,
then also, go ahead. I'm sorry.
yeah. They funneled it there because the Fed was paying more for them to keep those funds there. But now you can get more for like treasury bills. So
Hmm.
they're taking that out of there and they're buying treasuries. What that does is that that fills up the coffers of the U.S. Treasury, so they
Hmm.
can go out there and keep spending more. So that's why it's inflationary. So and
Yeah.
that's dropping very quickly. So that's like even though the Fed's during quantitative tightening, that's actually neutralizing that. And the other thing the Fed is doing, it's bailing out the banks with that
Correct.
BTFP.
Right.
Because I think the banks are they can only be getting more and more trouble because we're seeing bond yields. 10-year yield made a new high this week, around 4.5%. The
Yeah.
30-year mortgage rate is at over 7.5. So, and these banks hold a lot of these securities on their balance sheet. So, yeah, things are shaky. How they'll keep it going, I don't know.
Yeah. Now, speaking of which, let me get to a couple more articles here. So, talking about bubbles, just let me bring this up here. Just one of many bubbles, the unaffordability of housing. So, this headline here, this little graphic here is just very, very, very troublesome. But let me zoom in here. It says we're in the biggest housing bubble in 2023. Home prices adjusted for inflation are 85% overvalued compared to their 130-year average. So as I was looking throughout this, normal median range here, just to see where we're at now, and all that fueled by the financialization of the workforce, as we just talked about, the manipulation of government using central banks to just borrow into existence, and central banks monetizing a little bit of everything, and so certain pockets in this country here, things are cooling off significantly, and it's starting to concern a lot of people because you can't hide the numbers. But then again, I've noticed that Zillow and Redfin, some of the primary housing tools people use, even they're fudging their numbers. So between the government fudging numbers and these companies fudging numbers, it's like everybody's trying to keep the facade that things are somewhat steady, they're calm. But then again, I would
Yeah.
disagree.
Here as well, the average nationwide average house price, that's been going down this year
Mhm,
compared to last year, and we had the biggest drop since '09. And,
mhm,
and I think that's why they're desperately manipulating the data.
mhm.
Last year in May, the government asked the Office of National Statistics, which is our equivalent to the BLS, to recalculate CPI all the way back to 1949. So
Mhm.
magically, CPI now is lower than it was before May, by 1%.
Yeah.
And yeah, and uh, they had a CPI that came out. It was a little lower than expected, and the Bank of England just stopped raising rates because they know they keep raising rates.
Mhm.
The whole housing bubble here bursts, and they just want to keep it going, and
Yeah.
that's why the pound has dropped so much in the last few weeks. If you look at the chart of the British pound,
Yeah.
uh, I think it's probably going to accelerate lower, and that in and of itself is going to make the cost of living crisis even worse. It will
Mhm.
keep the people who are highly indebted, that have fairly good jobs, okay, but it's going to be the people at the bottom that are going to suffer
Yeah.
because their incomes are not keeping up. And so I expect more and more strikes here
Mhm.
too.
Mhm. 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 Yeah, for sure. So speaking of which, of higher rates, so the U.S. 30-year mortgage rate, just once again, so literally, so could this go to double digits? So based upon the Fed's current position of they're going to pause for now, but then again they see the potential of more rate hikes. So we could literally see possibly 8, 9, 10% mortgage rates, and then how catastrophic will that be on top of all the other concerns with credit card
Yeah.
rates through the roof and you name it. So
Yeah.
like it just doesn't stop with just one particular sector.
No,
They're all interconnected because of
you
debt.
know, I've been a student not just of the fundamentals of the economy, what's going on, but also technical analysis. And
Mhm,
looking at that yield chart, it looks really bad because you had to move up from the beginning of 2022 from around
mhm,
3% all the way up to like last year around 7.5. Then it
mhm,
dipped and consolidated, and now it's
mhm,
broken out again. And usually that's called a consolidation pattern. So we should see the same move that we saw from the beginning of 2022 to the end of 2022, now
mhm,
to the upside. That would take us comfortably above double digits, and that's why
mm,
I'm thinking there's gonna something's gonna happen where they're gonna have, and I don't know what that something is, some kind of crisis where the Fed and the government will have an excuse to step in and print again. That's, I think, might happen, and they'll have an excuse there.
Mhm.
If not, I think we will see by 2024 or 2025 a 10% mortgage rate. I
Mhm.
mean, that wouldn't surprise me. A 30-year. I mean, the U.S. is in better shape for the borrowers because you can fix that for 30 years. Uh, but here in the UK, for example, people fix their mortgages more for like 2 or 3 or 5 years. We don't
Mhm.
have such long fixes. But
Yeah.
if that were to happen, though, the people who would suffer from these higher rates would be the banks, the financial institutions that have
Right.
lent out, and that was their asset that's now becoming worth less and less as yields go up.
So if there's a possibility of the 10-year mortgage rate, so when it comes to the 10-year and the 10-year and the 2-year, how high do you see those and other subsequent
Yeah, I mean,
bonds? How high?
we were talking there about the 30-year mortgage
Mhm.
rate,
Mhm.
but the 10-year yield right now, I mean, we could easily go to 5.5% by
Mhm.
sometime next year.
Yeah.
And even Jamie Dimon is talking about that rates could go a lot higher. I mean, um, I remember back in the early 2000s or late 1990s, uh, the 5-year note got down to 5%, and that was really low at the time.
Mhm.
And but I remember trading these things, bonds, treasuries. That's where I started out. I did a lot of, actually, not the futures, but the actual bond, and they had a yield of more than 6, sometimes 7%.
Mhm.
So that's totally normal. What hasn't been normal is what we've had since they started QE in '09, and
Right.
but that's why it's going to be so disruptive, because we've had almost a full generation that doesn't realize that the rates that we've had since '08, '09 are not normal.
Right.
So a 6 or 7% rate, people might think, "Oh, you're crazy! It's never going to go there," but it's normal.
Mm, normal. What is normal in this abnormal environment
Mm.
is what we're going to end up finding out. Now let's get. Let me. So I want to share that with another little. Let me visuate here. You showed from Rafi. Let me bring this up here. Yeah.
Oh yeah,
Let me zoom in some. What? Let me zoom in here. So it says the 10-year and the 3 month yield spread broke through the 50-day weekly moving average yesterday. Here's something what haven't happened, which hasn't happened since 1990. What is that actually referring to?
yeah. So this is the difference in. You see, the curve has been inverted. So the 3 month T bill has been
Mhm.
yielding more than the 10-year, but and it bottomed there around minus more than minus 1.5. But
Mhm.
now it's disinverting,
Yeah.
and if you look back in time, when that started happening, you had major crises. You had 2020 there. You
Mhm.
know what happened in March. You had
Right.
'07, '08. You had 2001 dot-com bubble burst,
Mhm.
and then you had early '90s there, I think, or yeah, well, mid '90s there. I think there was a huge crash in the bond market,
Mhm.
and also yeah, it led to the Asian currency crisis, the
Yeah.
collapse of the Russian debt. But also in the early '90s, we had a big the savings and loans debacle, and the
Mhm.
recession of the early '90s. So there's one exception there in the '98, '99, but this looks like yeah, something will happen soon,
Yeah.
uh, and we'll see what the Fed does, though.
Yeah. Now, as a result of all this unraveling, the currency, the dollar. A lot of people still say, well, it's the cleanest out of the dirty basket of laundry, so the world still will recognize it because they're going to run towards it, and it'll somehow someday allow the Federal Reserve and the government to continue to do what they've been doing forever. But then again, some people, such as myself, and I'm sure you as well, think that this time might be different, where there won't be such a rush to get into more of U.S. liabilities, and then that comes into play. What we talk about gold and silver, and so I want to bring up that bring up this chart here that you also shared with me about what's happening out east. And so SEV Silver Day trading. So here you said talking about the was it the premiums you're referring to?
Yeah, I mean, in Shanghai today, silver closed at 25.40, and right now we're like 23.60. Well, it's
Mm-hmm,
come off a little bit. It wasn't. So it's trading at a over 7% premium to the
mm-hmm,
COMEX. And the other thing about foreigners holding treasuries and dollar, they usually hold their dollar reserves in treasuries. But
mm-hmm,
if treasuries are going down in value, like if you're holding a 30-year bond, apparently that was issued in 2020,
mm-hmm,
that had a coupon of 1.25%, or maybe a little more. Now, apparently, that same bond is worth 48 cents to the
mm-hmm,
dollar. So I think it's one of the reasons why foreigners are buying so much gold, the foreign central
mm-hmm.
banks, because
Yeah.
they're trying to get out of these treasuries, because they know rates are going up and the value of these treasuries are going down. So their reserves are going down. So what I think they're going to try to do is to get out uh, of their short-term treasuries that haven't lost as much, and
Mm-hmm.
buy as much gold as possible. Unfortunately, they're going to have to probably swallow the losses in the longer-term treasuries. And
Yeah.
some people, like our friend, the dollar milkshake guy, he made a good point. He
Mm-hmm,
said that maybe the Fed is doing this on purpose, slamming the bond market so that
mm-hmm.
foreigners are forced to hold on, because if they
Yeah.
liquidate, they take a huge loss.
Mm-hmm.
But I'm not too sure if they're really thinking about that. But it's also hurting the banks, the
Yeah.
U.S. banks, not just foreign central banks.
Yeah. But
But
now, but now, but
yeah,
now that they've added that backstop that allow the banks to unload some of their losses, they can probably contain it, because we're gonna literally see that continue to spike up weekly, just like the reverse repo did 2 years ago, where it was an anomaly at the time, but over time it becomes normal. So they can
yeah,
probably cushion the banks somewhat.
yeah, it's kind of flatten out that BTFP, but you're right. They could increase at any time, and
And speaking of which, let me. I want to talk about earlier this week about what some call the
or the
U.S.
glitch.
bond glitch.
Yeah.
And so clearly, it's a sell-off. So, what are your thoughts on that? What were you seeing?
Well, no, what it was. It was in the 2-year note yield, and it
Hmm.
was a Saturday night.
Hmm.
Uh, Asian trading probably, but uh, the 2-year note yield at the time was trading around 504, the yield, and apparently went up to 5.5.
Hmm.
I think it's a glitch, and why? Well, because it's happened in the gilt market. Well, all it is the data provider there. Uh,
Hmm.
because the 2-year note yield, there's always one that is on the run, because after 6 months it becomes a 1.5 year note, so they
Hmm.
have to replace it with a new one to keep, because the yield is supposed to represent 2 years. So I
Hmm.
think what happened is the service, the data provider, they for some reason put in the wrong 2-year that used to be a 2-year, but is now like a 1 year yielding
Hmm.
550. So they had to like take it out of the system and put the new one in, and it looked like a spike in the
Yeah.
thing, because I called one of my friends. He's retired now, but he traded treasuries all his life, and he
Hmm.
follows it still. And he said, Mario, that's just that's not. It didn't happen. It didn't do that.
Hmm.
So yeah,
Yeah.
uh, it
So
still does. It still doesn't mean that the bond market isn't in trouble, because I think the U.S. Treasury, they want to start doing buybacks of the old
yeah.
treasuries, because it's very illiquid. It's been illiquid for almost 10 years. So the 2-year that we see on the system, that's the most liquid one. So I don't think anything happened there. It was
Yeah.
just because I looked at the investing.com. I followed the yields on there, and
Yeah.
there was no spike or anything.
Mm. Interesting. Okay, so I was just curious, just because I saw it the next day, people were like, "Oh, it's going down." People they getting out, they dumping, and it so happened to come right before the Fed announcement of a pause. So maybe somebody was getting out ahead. So it was just a lot of
Yeah.
speculation as to what was going on out there. What else we got here? So article wise, we got a couple more things we can touch on. You want to go into the Q&A portion? What you want to do?
Yeah,
How you
Q&A
feel?
is fine. Yeah. Well, someone
All right.
just said 4-hour glitch low. Well, if you look at all the other data providers for the treasury yield, it was only one that you saw that spike.
Mhm.
But I don't think anything happened because, yeah, they're just changing the bonds. That's
Yeah.
all.
Fair enough. Let's open up to some Q&A. So feel free, for those who are tuning in, if you have not already, definitely hit the thumbs up button, show your support for the channels, and then also feel free to throw out some questions, whether at Manico64 or at RTD, so to stand out, and then it makes it easier for us to recognize and then to put it out there. So please do that. Here's something. It says, "How much is an ounce of silver in Zimbabwe or Venezuela?" A number followed by several zeros.
Yeah, also
Whatever that number is.
in Argentina too, I guess.
Yeah. It says Spook still got. Let me see. Hook up for 7 savings. Wish Boston. Zelensky. Yeah, Zelensky is over here in the U.S.
Oh
pleading for
yeah,
more funds. There's Rob B says, "What about the New Jersey senator arrested for today for gold bars for bribes?" Yeah, I saw that. A senator.
yeah. I saw that story. And
This guy. Yeah. So the gold just shows somebody wants gold. He knows the value of gold. Charles says, "Mario, are there credit unions in the UK? What are the thoughts about credit unions?"
yeah, I think there are credit unions here. They're no safer than the banks, I would say. I mean, I've had this question asked many times. No,
Hmm.
they're not as safe because a lot of times they keep their funds with the banks.
Hmm. Hmm.
So,
I think it's policy. They have to keep certain portions of their deposits in the hands of the central bank. Correct.
or like the commercial banks, yeah, or maybe even the central banks. But I think the safest bank is your own bank. You know,
Mhm. Yeah.
keep stuff yourself. Um, and the thing is that legally, anything you keep with a credit union or a bank, it's not yours. It's an unsecured loan.
Right. You are the creditor. Josh says, "What would you buy in the UK if you only had £500?"
What do you mean? I don't really get that.
So,
Buy?
so assume if you had an extra 500, would you just go get all silver? Would you go take your wife out
Oh,
to dinner?
that-
I guess.
yeah. Well, I think so. Uh, well, maybe buy one sovereign, which is
Mhm,
about just under 400 pounds, and the rest buy some a few silver Britannias. That's what I would
mhm.
do with 500.
LBP says, "Mario, what happens to bonds in high inflation situations? Argentina, Lebanon, Venezuela, or Zimbabwe?"
Well, bonds become worthless because, you know, like during the Weimar hyperinflation, if a bond was yielding, 10% a day,
Mm,
but then inflation started moving to 20%, what's the point of holding something that's losing 10%? So the bond market breaks down and just collapses, and people
yeah,
don't really want to. Yeah, people don't want to lend the money. They want
right.
to just get rid of the money for something real. So that's what happens to bond markets like that. But also uh, when there's bankruptcy, bond yields also go through the roof and bond prices collapse, just like we
Mhm,
saw in 2011, 2012. The Greek 10-year yield went up to 40%. So if it wasn't for the ECB and Mario Draghi to bail them out,
mhm,
you know, they would have gone bust, and a lot of the banks would have failed because banks again and pension funds, they hold this rubbish that's supposed to be risk free,
mhm.
and the safest thing on the planet.
Right. I don't think there's no amount of return that I would want to receive in a failing currency, denominated in a failing currency. Like
Well,
the
here in
risk
the yeah
is too
here in
high.
the UK, uh, up until 1997, they measured inflation with something called the RPI, which is
Mhm,
still published. And the RPI is 9.1%. And back in 1990, the RPI went up to 10%. And the
mhm.
Bank of England rate was almost 15%. So they had it right. They did
Yeah,
stop the inflation there, but they had a really bad housing crash and a bad recession. But now
mhm,
RPI is at 9.1 and the Bank of England rate is at 5%. It's not going to bring down inflation. It's not going to
right,
slow things down.
right, and they know that. They know that. So here's another question: says, what mortgage rate would you need to see for housing to become affordable again? And as you were talking about how we're living in an abnormal time, or it was normal to have interest rates of 6 or 7 back then, but now we're in the new near zero bound territory. I'm not sure what will be considered normal, just because there's so many other factors to
Oh, yeah.
consider in the debt market. So I don't know if there is a normal affordable interest rate
Well,
really.
I
Because
mean, what the very low rates for almost zero rates for years did
Mhm,
is that it allowed people that couldn't really afford to
mhm,
buy a certain house for a certain price to do it because they just kept as long as they could cover the monthly interest payments. A lot of people took more interest only mortgages as well here in the
mhm,
UK. Uh, and like you said, depends on a lot of things. If you have a good job and a safe job and you're earning well, you're fairly young, you could afford. I mean, my wife, before I met her, when I arrived in the UK, she had bought a flat, an apartment,
mhm,
and she didn't have a huge mortgage, but
mhm.
she told me she was paying 12-15% rates, and she could afford it though. So it
Yeah.
depends on the individual. But if you've leveraged yourself, like a lot of people have here, I've heard of people that, they have a normal 9 to 5 job.
Mhm,
They're not happy enough with having just their home, buy that and
mhm.
put a mortgage. They were so greedy, they bought another one as well to rent out while they still have a
Airbnb.
job. Yeah, rent out with no interest only. Now that
Mhm,
rates are going up, they're in deep trouble, and I've got no
mhm.
sympathy for those kind of people, and that's
Right. I think the Airbnb, so that little 2 or 3 year stint from this previous, shutdown, lockdown period, a lot of people went out and got adjustable rate mortgages, and now them boys is not doing too pretty to where, like, just the Airbnb in itself, that sector is literally threatening the housing market, some fierce throughout the
Fox
country.
Fox Moongaze. Are UK building societies safer than banks? Nope. And most of them have turned into banks anyway. But no, they're not any safer. You saw Northern Rock was supposed to be a building society that went bust because that turned into a bank. So no, there is no safe. I would say there none of the financial institutions out there are safe, nor the building societies, the banks, nor the brokers are
Mhm.
safe.
Good point. It says Mario, how are these inverses will last in the interest rates, and are they unwind in long bonds now? How are
What's
these inverses?
inverses?
I don't know. I think probably goes back to one of the charts we showed where
The reverse repos?
that I don't know. How are these
I don't know.
inverses that will last interest rates? Are they? I don't know. Well, William, do me a favor, clarify that question for us so we can
Yeah.
read a little bit better. What else we got here? Credit unions. Fed would bought down 10 years the other day for what? So what happens to stocks if we go to CBDC?
What's
I'd
this?
imagine
The Fed
we're all
bought
going
down
to a
the 10-year
CBDC.
yield a day
Say
from
again.
5. I'm not sure what he's talking about. The Fed bought down the 10-year yield. When was that? The 10-year yield, we're right now near 4.5, but it hasn't been near 5 for over 16 years. But anyway, not sure what he's going on about.
Don't know. Speaking of which, I actually have the 10 year right here. What is this? Yeah,
Yeah,
it's been a minute. Oh, we at
yeah. The last time it was at
2007.
5. The last time it was at 5% was 2007. So I think he's talking about the 2-year note. Like earlier this week, it jumped on the screen from
Yeah.
Yeah, I'm not sure what that is.
What else we got here? Look, guys, Biden is being played like an actor. Says, look, guys, we all know Biden is being played like an actor. What is it all about? I just think literally he was placed in that position just to be the puppet that allow all his handlers around him to pull out their
Yeah,
agendas. And
I
so
think
Ukraine, of course, is one of the primary things they want to continue to use.
yeah, it's not a very popular opinion, but I think all politics is theater. It doesn't
Yeah.
matter what side of the aisle. Uh, if you look at the Republicans, when they've been in power, they've spent and racked up the national debt just as much as the Democrats.
Hmm.
The same thing here in the UK. The Conservatives are not any better than Labour. They're just the same. They're different cheeks, the same. You know what?
Right.
so, it, and it's sad that people still keep hoping that someone's going to come on a white horse and save them.
Right. Right. I mean, the system is too far gone. And I was thinking about the other day, I mentioned this in one of my little rants saying that, for people who promise on, you know, unending the system or draining the swamp or whatever, I'm like, the government in of itself is a swamp. Like, one single person can't come in and make all that change by
Yeah,
themselves.
I think the
So,
guy that had a chance to do it, they infiltrated his movement, the Tea Party movement, Ron Paul.
mhm,
He had a chance to do it, but everything after that, after Ron Paul, is just controlled opposition, I think.
yeah. Here's another question. RTD, if you could, would you buy property outside of the city now or wait to anticipating crash and a much lower price point? Great question. So actually, I'll be honest with you, I'm actually looking at this current moment, anticipating the fact that if I wait too long, the opportunity to be able to actually acquire it may not be available due to the bank disruptions and everything like that. Because I'm of the firm mindset that like a very select few will actually have the ability to get access to their full amount of currency within the bank to use in the midst of a crisis. Because I think they're preparing for this and they don't want nobody to really profit off this other than their big
Yeah.
boys club. So the
Well,
Warren Buffetts, they got permission to use
yeah.
their funds. But
Well, the other thing as well, one of my uncles in Brazil back in the late '80s,
mhm,
he's still alive. He's a doctor, uh, allergist, allergy doctor, but he had a practice, and he bought like a house for his practice, and he completed the purchase. He paid the seller, and
mhm,
then so he had the place there. Then the next day they had a currency reset, a new currency.
mhm,
So he was really lucky because the guy who sold that house, he was left with this currency that became like worth a
mhm.
tenth of what it was the day before. So like you
Yeah.
said, it's dangerous to have huge. Let's say you sell a house and
Mhm,
you rent, and then you're looking to buy one somewhere else, and you leave that huge amount of deposit with a bank. In
mhm.
this environment, I wouldn't feel comfortable at all
Right.
having, let's say, $250,000 or $500,000 in the bank waiting to
Mhm.
buy a property.
Right.
And I would, that's the way I look at my residence is not an investment, even though it has worked well over the last 30 years. I look at it as a place to live.
Mhm.
I don't try to time it or anything like that.
Right. Right. And just the concept of, or how they say that the equity in your home is the bulk of majority of people's savings. Like I'm thinking, like in this current environment, when markets are going to be very turbulent, you can lose that in an instance. And
Oh yeah,
then what? Like if
but
you're literally go
and
ahead.
I don't think you should worry unless you have a huge mortgage. Let's
Mhm,
say you live in I mean, in the UK is a little different because in the US, you can go live somewhere else where it's a lot cheaper. But
mhm,
here as well, but not as much. But let's say yields keep going up. The more house prices go down, so your house goes from being worth 100,000 and it becomes worth 50,000.
mhm.
Have you really lost anything if the houses, that you wanted to buy somewhere else have also gone down? So
Right.
I wouldn't worry about it. I'd worry about it, of course, if I borrowed 90,000
Mhm.
and the house is only worth 50 now.
If you're underwater, then that's a problem. But beyond that, if as long as you got a roof over your head in the midst of chaos and you ain't got to get that boy back to his
Yeah.
rightful owner, you're good, in my opinion. So That's kind of how I see it.
Yeah, Mr. Boston says there's no middle class left. I agree, and it goes back to that what we were talking about earlier in the live stream about the CEO
Mhm.
earnings and how
Yeah.
the average worker has been basically, like hard done by. It
Mhm.
hasn't really done well, and a lot of the corporations, they've moved all their production to China. The
Mhm.
WTO, that also has eviscerated the middle class.
Yeah.
I guess the only solution to that is to allow the market to do things because I think if we go down the road of Argentina, the government always trying to help. The
Mhm.
government says, "Oh, we're going to invest in heavy industry and bring back jobs." That's not going to work.
Yeah. So speaking of which, the government wanting to help out again. So Chicago explores possibility of a city-owned grocery store in effort to improve food access. So
Yeah,
the
right.
city of Chicago, who is already underwater, residents already vacated. They're taxing the people who remain there, and they're even talking about increasing the corporation tax. And so the CBOE is talking about if they do that, they might be leaving as well.
Well,
So
I saw that what's the governor of Illinois now? Is it Pritzker or something like?
this, I don't know. I don't know. I don't know. I'd be
But
lying if I said I
the
knew.
Pritzker family, they're like Illinois oligarchs, and I saw
Mhm.
that I think Biden just made a woman called Pritzker the the woman that's going to help rebuild Ukraine. So I'm sure they're going to do quite well
Oh
for that.
man, so look at that. Look at that. There's no coincidence that
No, but
whatsoever.
I mean, will that work? A publicly city-run
Corporate communism.
store?
No,
Probably not.
not at all. Not because they got to. They got. They're going to have to fix the prices. And
Yeah,
so where the
actually, my wife was talking to me the other day, and I hadn't thought about it like this. So you got to thank her,
Mhm,
because here in the UK as well, they're allowing people to just rob small shops,
mhm,
pickpocket.
mhm.
San Francisco, like if it's
Yeah,
under $1,000,
yeah.
and I thought, well, that's just the rule of law breaking down, property rights. But if you think about it, that drives small businesses out of business because they
Mhm.
can't cope. So what do you get? Well, you get the big, you do everything online. That
Mhm.
helps Amazon, doesn't
Amazon,
it? Yeah,
Amazon,
Amazon,
behemoth of a monster in WalMarts.
Uber Eats. I mean, here as well, Uber Eats and Amazon.
What we got? All right, we have 50 minutes, man. I don't see any more questions to deliver. I see a lot of thoughts, but appreciate everybody for hanging out with us on a Friday, man. It's always good to connect, and hopefully, you guys
Yeah.
were caught up to speed on some of the events that's taking place, as well as informed us of what's yet to come. So we are at the end of September. Mario, what's coming up that's worth paying attention to? Anything that you are aware of or in tune with that people should keep an eye out for, or what?
I mean, not really. I guess
Not
we
really.
had the important central bank meetings, but no, nothing really. I mean, this time of the year, though, September, October is always uh, a time of the year that's difficult for markets sometimes, can
Mhm.
be. But
Yeah,
I guess also this government closing down in the U.S.
yeah,
That could affect things,
yeah.
and
It definitely will.
mm.
Well, yeah, it's never gonna be a dull moment. So there will be something
No,
that
and the other thing as well, keep an eye on the that 10-year yield. If it keeps going up,
mhm,
that's not good. And someone said the other day, "Oh, you said all hell would break loose if we went through 4.4." But if you look at the Nasdaq, it's got its biggest monthly drop since December
mhm,
last year, and that's because of the bond yields.
mhm, mhm. All right, well, good people. Enjoy your weekend. Unplug, get out, enjoy nature, hug a loved one, tell somebody you love them, give a stranger a text or a call, tell them you're just thinking about them. That's be a good way to spread the love, my good people. But other than that, be blessed, be safe, and we'll see you next week. Well, of course, we're gonna have more to talk about. So hit that thumbs up on the way out, people. See you guys.